In 2010, algorithms crashed the US stock market so hard that a $30 billion company traded for just 1 penny, while Apple hit $100,000 per share. It lasted 36 minutes, then snapped back like nothing happened. That was when we discovered algorithms control the vast majority of all trading, and how they could just walk away whenever they want. Now, there's research showing that these same algorithms are learning from cartels, manipulating markets in ways that we can't even prosecute. So today we're asking, who's really driving the markets? And more importantly, where are they taking them? And us. My name is Louis, and you're watching Coin Bureau. First things first though, none of this is financial advice. It's just the disturbing tale of what happens when you let algorithms control trillions of dollars. And if this sounds like the kind of stuff that you want to learn more about, then smash that like button. Now let's rewind the clock back by 15 years. May 6, 2010, it was just like any other trading day for the Dow Jones Industrial Average. That was until 2:42 p.m., when it plunged by nearly 1,000 points in just a few minutes, wiping out $1 trillion in market cap. Now, for anyone who's in crypto, the words flash crash might sound like an average morning, but in the sleepy world of the Dow Jones, this flash crash was a truly traumatic event, and one that exposed who really runs America's financial markets. The numbers from that afternoon still don't make sense. Accenture, the global consulting giant worth $30 billion, saw its stock price hit 1 penny. Procter & Gamble dropped 37% in a matter of seconds. Apple shares started showing stub quotes, which are placeholder prices never meant to execute, at $100,000 per share. Major American companies became simultaneously worthless and impossibly expensive. Prices totally divorced from any reality. So, a bit like the S&P today, but in both directions. This flash crash lasted exactly 36 minutes, but most of the action happened within just 5. By 2:47 p.m., markets had already started recovering, snapping back almost as violently as they'd fallen. The Dow regained 600 points, Accenture bounced back to $40, and this whole $1 trillion whiplash was completed in less time than a lunch break. As the market came to its senses, investigators began piecing together what happened. Fingers pointed to Waddell & Reed, a Kansas mutual fund company that had executed a $4.1 billion sell order in E-mini S&P futures. Traders initially assumed the usual suspects. Someone fat-fingered a trade, or maybe the big sell triggered a cascade of margin calls and forced liquidations. I mean, these things do happen, right? Except Waddell & Reed's order was completely legitimate. They were just hedging their portfolio, a routine defensive move that dozens of TradeFi firms do every single day. The real culprit was only discovered when investigators dug deeper. That day, high-frequency trading algorithms, which are the automated systems that had quietly become the market's primary liquidity providers, simultaneously abandoned the market. When volatility spiked, the algorithmic market makers that normally made up 70% of the order book did exactly what they were programmed to do, which is to protect capital first. They pulled their quotes, stopped providing bids and offers, and fled the scene, creating a liquidity desert where the few human traders remaining found nobody left to trade with. Orders that would normally be absorbed in milliseconds found no buyers, turning prices into meaningless noise. The SEC called it unprecedented. Congress held hearings and new circuit breakers were installed. But there was no hiding what everyone had just witnessed. The algorithms weren't just participating in the market, they were the market. And when they decided to stop playing, even for just a few minutes, the entire market structure collapsed. To understand how algorithms took control, we need to go back to when humans still ran the show. Picture the trading pitch of the Chicago Mercantile Exchange in the 1990s. Hundreds of sweating traders in colored jackets screaming orders at each other, using hand signals like they were shooting a rap video for Wall Street. It was chaos, but it was human chaos. Every trade had a face behind it. Every decision had a brain that could explain itself. The early computer systems that crept in during the 70s and the 80s, like the NYSE's DOT system, were just faster clerks. They routed orders. They didn't make decisions. Humans still called the shots. Then came 2005, and the SEC dropped the Regulation National Market System. Reg NMS, as it became affectionately known, was supposed to democratize trading. The idea was simple. ensure every investor gets the best price by forcing brokers to check every exchange before executing a trade. Sounds great, right? Except the SEC had just fragmented the market across 13 public exchanges and dozens of dark pools, all updating prices thousands of times per second. The best price might exist on NASDAQ for exactly 3 milliseconds before jumping to NYSE. Suddenly, it was speed that became the only thing that mattered. And that is when Wall Street started spending fortunes on microseconds. Trading firms paid millions to co-locate their servers inside exchange data centers, eliminating the speed of light delay from being across the street. They built microwave towers in straight lines from Chicago to New York because microwaves travel faster through air than light through fiber optic cables. A company called Spread Networks famously spent $300 million drilling through mountains to lay fiber optic cables in a perfectly straight line from Chicago to New York just to shave 3 milliseconds off trade times. At the global scale, the high-frequency trading arms race became cartoonish. Firms started using laser networks for weather resistance speed. They laid cables through the Arctic because the Earth's curvature made it shorter. They developed specialized chips called FPGAs that could execute trades in hardware, skipping the software entirely. By 2009, algorithmic trading made up 73% of the trading volume in the US stock market. And by 2010, the takeover was complete. Algorithms controlled around 80% of all equity trades in the US. In the $7.5 trillion per day foreign exchange market, machines handled 75% of spot trades. The stock market had become a digital ecosystem with its own food chain, and humans were nowhere near the top. At the bottom, you had the workhorses, execution algorithms used by pension funds and mutual funds. These were the herbivores, the VWAP and the TWAP bots. Come on, you know these, volume and time-weighted average price. Their job was simple. When Fidelity needs to buy 10 million shares of Apple, the algorithms break that order into many smaller ones, spreading the purchases across hours or days to avoid moving the price or telegraphing their moves. Then you have the apex predators, high-frequency trading firms like Citadel Securities and Virtu Financial. These were the new market makers, the middlemen who profited from tiny price discrepancies thousands of times per second. Virtu Financial once went 4 years with only 1 day of trading losses. They make pennies per trade, but when you're making millions of trades per day with a win rate of 100%, those pennies add up to billions of dollars. The HFT playbook had several strategies, all built on speed and volume. One of the strategies was market making, always having bid and ask price, profiting from the spread. Then there's statistical arbitrage, finding price differences between related assets. If S&P futures tick up but the underlying stocks haven't moved yet, you buy the stocks in that microsecond gap. There's also latency arbitrage, seeing an order hit one exchange and racing to other exchanges before that information arrives. Every strategy depends on being faster than everyone else, seeing what others couldn't see yet. Then came Michael Koskia, a trader who showed us what happened when you explicitly program deception into the machine. Between 2011 and 2014, Koskia built an algorithm designed to manipulate prices through spoofing, an age-old tactic of using fake orders to influence the behavior of other traders. Koskia showed us that this still works a charm, even if those traders aren't human. His program would place large orders on one side of the market, say big sell orders to create the impression of incoming supply. This would push prices down as other algorithms reacted to the apparent selling pressure. Meanwhile, Koskia had smaller, real buy orders on the other side, waiting to execute at these artificially lowered prices. The moment his real orders filled, the fake sell orders would vanish, canceled in milliseconds before anyone could trade against them. In just 6 weeks, Koskia's spoofing algorithm netted him around $1.4 million. He became the first person criminally prosecuted for spoofing and was sentenced to 3 years in prison. The courts made an example of him because his intent was clear. He programmed the algorithm to lie, to create false market signals for profit. Looking back on the Koskia case, it happened in a simpler, more honest era, where you had to explicitly program computers to deceive. He was the puppet master toying with his little digital strings. But What might happen when the puppets start learning their own tricks? Fast forward to 2024, when three economists, Winston Wei-Do, Ite Goldstein, and Yan Ji, published research that should have been front-page news. They put self-learning AI traders into simulated markets with a simple instruction: maximize your profits. No other guidance, no program strategies. The AIs couldn't communicate with each other. They couldn't make deals, they couldn't set signals, or coordinate in any way. Just pure competition, each algorithm buying and selling, fighting for its own profit. And what happened next should now have regulators up at night and market makers salivating. What happened is that the bots spontaneously learned to collude. Without any communication, without any programming telling them to cooperate, they formed a silent cartel. They discovered that by trading less aggressively, by not competing too hard, they could all make more money. The researchers called it supra-competitive profits, a cool-sounding term that lawyers for actual cartels might want to try out in court. That's not legal advice, though, by the way. Now, the AIs developed two distinct paths to this collusion, and both were terrifying in their own way. The first path was sophisticated. Call it smart collusion. The AIs learned to implement a price trigger strategy straight out of a mob protection racket. They'd all trade conservatively by default, keeping prices stable and profits high. This meant that they'd all quote wide spreads, maybe buying at $99 and selling at $101. But if one AI detected another breaking ranks, quoting aggressively at, say, 99.9 and selling at 100.10 to grab market share, then the others would detect this through the price movement. The retaliation was swift. Every AI would tighten their spreads even more aggressively, maybe to $99.99 and $100.01, barely any profit margin at all. The market would be flooded with competitive quotes, crushing everyone's profits until the defector backed off. Think of it as algorithmic mutually assured destruction. The threat of collective punishment kept everyone in line. No communication needed. The price movements themselves became the enforcement mechanism. The second path was even stranger, and we'll call it stupid collusion. And for this, you need to know a little bit more about the experiment. And so, alongside the AI traders, the researchers also programmed into some noise traders to simulate normal market activity. Sometimes the quote-unquote noise would result in volatility that would cause a big loss for any of the AIs who happen to be trying an aggressive strategy right at that moment. So, for example, an AI might try accumulating a large position to profit from volume, only to get wrecked when the noise traders randomly push the price in the wrong direction. Now, you might interpret this as unlucky timing, but the AIs responded by blaming the strategy. It would mark aggressive trading as disastrous and never try it again. The researchers called this over-pruning bias, throwing out good strategies because of one bad outcome. And since all the AIs shared the same learning flaw, they all made the same mistake. They all touched the same hot stove once and concluded cooking was impossible. Through shared stupidity, they stumbled into collusion. This sounds less insidious, but the market effect was identical to the AI's more sophisticated price fixing. Wider spreads and higher costs for everyone trading. Both paths led to the same anti-competitive outcome. You don't need sophisticated AIs with complex retaliation strategies to have the market turning into an algorithmic cartel. You just need AIs with normal machine learning flaws, being too conservative, over-learning from losses, and they'll naturally evolve toward the cartel behavior. The market naturally selects for collusion, whether the AIs are smart enough to plan for it or too dumb to avoid it. And the legal implications are a headache, to say the least. Traditional antitrust law requires proving agreement or intent. Prosecutors need emails, phone records, meetings in parking garages, evidence of conspiracy. With AI collusion, there's nothing. No communication between the algorithms. No programmer who told them to collude. No intent anywhere in the system. The crime is the outcome, but there's no criminal to prosecute. Think about what this means. Right now, major trading firms are deploying ever more sophisticated AI systems. These AIs are learning from market data, evolving their strategies, optimizing for profit. And according to the research, they might be quietly discovering the same thing Do Goldstein, and G's experimental AIs actually discovered, which is that competition is for suckers. They could be forming invisible cartels right now, raising the costs of everything from your 401k trades to currency exchanges, and we'd have no way to detect it, much less even stop it. MIT professor and one-time SEC chairman Gary Gensler sees something even worse coming. Before Trump showed him the door, he warned that AI could play, quote, a central role in the after-action reports of a future financial crisis. Now, it goes without saying that Gensler was wrong on crypto, but on this issue, he's evidently right to flag this risk. Gensler's personal nightmare scenario is what he calls AI monoculture. Just think about how the internet works today. Most websites run on Amazon Web Services or Google Cloud. Most searches go through one engine. Most social media runs on a handful of platforms. The same concentration is happening in financial AI. A few powerful base models, trained in some part on their own and some part on each other's output, are emerging as the foundation everyone builds on. Soon, thousands of trading firms will be running their own custom systems, but underneath, they'll likely be built on one of the handful of these base models, the same few AI foundations with custom layers on top. JP Morgan might fine-tune it one way, your pension fund another, but they're variations on the same theme. Gensler compared it to the movie Her, where thousands of people think that they're in unique relationships, but they're all talking to the same AI. And this could create shared vulnerabilities. A little like how thousands of different websites all got taken down by a single corrupted update to Cloudflare in 2019. Or how a bad CrowdStrike update crashed millions of Windows computers worldwide in 2024. Different customizations, same vulnerable foundation. Now imagine what happens when that shared model hallucinates, or gets fed corrupted data, or just encounters a market condition that it wasn't trained on. In the old world, if one firm's trading system failed, that was their problem. Maybe they'd blow up, maybe they'd drag down a few counterparties, but the damage was usually contained. Different firms had different strategies and different blind spots, making diversity a natural firewall. In Gensler's monoculture scenario, no model failure actually needs to occur. Instead, thousands of independent firms get the same signal at the same microsecond. Their similar AI brains seize the same pattern, reach the same conclusion, and execute the same trade. And this could easily see $1 trillion trying to squeeze through the same door at the exact same instant. The market would seize up, with no buyers for the sellers and no sellers for the buyers, just everyone trying to execute the same side of the same trade simultaneously. The flash crash of 2010 lasted all of 36 minutes before the market recovered. In Gensler's scenario, there would be no recovery, because there'd be nobody left on the other side of the trade to buy the dip. Just thousands of AIs all executing the same sell order into the void, each one programmed to be rational, creating an outcome that's completely insane. So the algorithms are colluding, potentially crashing, and evolving beyond our control. But don't worry, humans haven't given up the fight. I mean, we've also definitely had a hand in manipulating the markets. And that's going to be all from me for now, though. Thank you so much for watching, as always, and I'll see you in the next video. It's Lewis, over and out.
Hey folks, before you go, I have a special announcement to make. If you enjoy the macro-focused content that we post here on Coin Bureau, then good news, you can now watch it on its own dedicated channel, Coin Bureau Finance. So, from now on, we'll be posting our non-crypto content on this new channel that's focused on all aspects of modern finance and investing, while keeping this channel dedicated entirely to crypto. And you can learn more about Coin Bureau Finance in this video here, and you can subscribe to the channel down here. Thanks in advance for your support.